Welcome back, traders. Today, we're diving into one of the most powerful tools in the trader's arsenal, candlestick trading. You'll learn not only how to read candles, but how to understand market psychology, spot high-probability setups, and avoid rookie mistakes that cost traders thousands. We'll walk through real chart examples, explain each pattern's meaning, and give you a repeatable system you can start using right now. Part 1. Candlestick Logic and Psychology. A candlestick is more than a shape. It's the psychological battle between buyers and sellers over a set period of time. Candlestick charts are one of the most popular tools in technical analysis used by traders worldwide. Their origin dates back centuries and combines both art and practicality in market analysis. Invented by Munehisa Homa, a legendary Japanese rice trader in the 18th century, Homa is often credited with developing the earliest version of candlestick charting. Homa realized that markets were influenced by emotions as much as supply and demand. His charting method combined price movements with psychology. Let's take a look on features of candlestick chart. Each candlestick represents a specific time period, example 1 minute, 1 hour, or 1 day, and shows 4 important pieces of information. The open, this is a point or lever where the price when the period started. The high, this is the point where the highest price during the period reached. Low, this is the lowest price during the period. The close, a point where the price when the period ended. Now each candlestick has 2 parts, the candle body and wicks. The candle body is the rectangular part of the candlestick which is called the body. It shows the difference between the open price and close price. Bullish candle, where the price goes up, the close price is greater than the open price and usually shown in green or white colors. Bearish candle, where price goes down, close price is lower than the open price and usually shown in red or black color. Wicks, also known as shadows, these are thin lines above and below the body. They show the highest and lowest prices reached during the time period. The psychology of candle body is very simple. Long body shows a strong buying or selling pressure. Short body shows a price indecision or consolidation. In bullish candles, buyers dominated the period. A strong close near the high shows confidence. In bearish candle, sellers took control. Close near the low make it to downward momentum. On the OddCAD chart in a daily time frame, you can see this bullish candle opens at 0.88409 and closes at 0.89078. The market shows strong bullish intent, especially if the candle closes near the high without long wicks. Now let's talk about wick psychology. The long upper wick means there is rejection at the resistance zone or supply zone. The long lower wick means there is a demand stepping in at the support or demand zone. Wicks give more information than the body itself, so don't rely on the body alone. Give more attention to the wick, especially on the support and resistance zones. Part 2. Key single candlestick patterns. There are several candlestick patterns that are commonly used for identification of trading reversal and trading continuation. Let's begin with a single candlestick pattern. The first candlestick pattern is hammer. This is the indication of the reversal marker which appears at the bottom of a downtrend. The psychology behind this candlestick pattern is that bears pushed the price down but bulls snapped market back hard. Another candlestick pattern is inverted hammer. Alright, so the inverted hammer is a candlestick pattern that usually shows up at the bottom of a downtrend, and it's a hint that the trend might be about to reverse. Imagine the market has been falling for a while, everyone is selling, right? Then suddenly, one day the candle opens, and buyers actually try to push the price way up. But by the end of the session, the price drops back down and closes not too far from where it opened. That candle ends up looking like a little body at the bottom with a long wick sticking up, kind of like an upside-down hammer. That's where the name comes from. Another candlestick pattern is a shooting star. A shooting star, it's not something out of the sky, but it can signal a drop is coming in the market. A shooting star usually shows up after an uptrend, when prices have been climbing for a while. It looks like a candle with a small body near the bottom, a long wick on top, and very little or no wick below. Here's what it means. During that candle's time frame, whether it's a day, an hour, or whatever, buyers tried to push the price up pretty aggressively. But by the end of the session, sellers took over and dragged the price back down near where it started. So even though it looked like a strong move up, it ended with a weak close. let's talk about one of the most powerful candlestick signals in trading, the doji. A doji forms when the price opens and closes at almost the exact same level. That means after all the movement up and down the market ends up right where it started. The result? A candle that looks like a cross or a plus sign. This tiny little shape carries a big message. Indecision. Neither the buyers nor the sellers could take control. It's like a tug of war that ends in a draw. But what makes the doji important is where it shows up on the chart. If you see it after a strong uptrend, it could be a warning sign that the bulls are losing strength. If it shows up after a downtrend, it might mean the sellers are getting tired. Part 3. Multi-candlestick patterns. Bullish engulfing candlestick pattern. Let's break down one of the strongest bullish reversal patterns in candlestick trading, the bullish engulfing. It appears after a downtrend, when the market has been falling and sellers are in control. Then suddenly a shift occurs. You get two candles. First, a small red candle that's the last breath of the bears. Next, a big green candle that completely engulfs the red one, opens lower, closes way higher. It literally swallows the previous candle. This move signals power. It shows that buyers have stepped in with force, and momentum is swinging back in their favor. Bearish engulfing candlestick pattern. Okay, so let's talk about the bearish engulfing. It's basically the opposite of the bullish engulfing. This pattern shows up after an uptrend, when the market's been moving higher and buyers are in control. Then suddenly, boom, things shift. You'll see two candles. The first one is a small bullish candle. It opens low and closes higher. The second one is a large bearish candle that opens above the first candle's close and closes below its open. So visually, that big red candle completely swallows or engulfs the small green one before it. That's why it's called bearish engulfing. What does this mean? It's a warning sign that buying momentum is fading, and sellers are starting to take over. It tells traders, hey, the bulls might be losing steam, and a reversal could be coming. Morning star. Alright, so the morning star is a classic bullish reversal pattern. It usually shows up at the bottom of a downtrend, and it's made up of 3 candles. Here's how it goes. The first candle is a big bearish candle. The trend is still heading down. Second candle. A small candle can be red or green, showing indecision. This is where momentum slows, and the battle between buyers and sellers begins. Third candle. A strong bullish candle that closes well into the body of the first candle. So what's happening here? The first candle shows strong selling pressure. The second candle shows that sellers are losing steam and the market is pausing. The third candle? That's where buyers come in strong and push the price back up. Evening star. Alright, let's talk about the evening star. It's the bearish twin of the morning star. This is a 3-candle pattern that shows up at the top of an uptrend, and it's a classic sign that the bulls might be losing strength and a reversal to the downside could be coming. Here's how it forms. First candle, a strong bullish green candle, everything looks like it's still going up. Second candle, a small candle either red or green, showing indecision. Momentum is slowing down, and neither buyers nor sellers are fully in control. Third candle, a strong bearish red candle that closes deep into the body of the first candle. Now you know how to read candlesticks and understand market psychology. But this is just the beginning. In the next video, you will learn how to analyze the chart using candlestick pattern. If this helped, smash the like button, subscribe for more advanced strategy videos, and hit that bell icon. Have questions about patterns or want me to review your trades? Drop a comment. I respond to every trader. Stay patient, trade smart, and I'll see you in the next lesson where we go deeper into multi-time frame candlestick strategies.